England and Wales during the final 3 months of last year look set to have hit a 30-year high, according to Insolvency Service data. Yet administrations, the procedure which seeks to rescue an underlying business that has become insolvent, appear to be levelling off. Figures from the risk advisory company Kroll suggest there were 105 administrations during December, up from 99 in November, but the rolling 12-month figure was more or less unchanged from the previous month. Well, joining me to talk about this is Managing Director at Kroll, Matt Ingram. Matt, welcome to you. The fact that insolvencies are still rising while administrations are tailing off, does that mean that fewer insolvent businesses are surviving?
I think, and good afternoon, Ian. I think there's a mixed picture that we see in the statistics at the moment. Liquidations, which tends to be a process that we see smaller companies use when effectively they've run out of cash, run out of working capital, and they're closing a business down. Those are very, very high. We've seen over 20,000 liquidations in 2023, whereas with administrations, we're seeing about 1,500, 1,600. So the smaller business, yeah, there's definitely some pain that we're seeing in the insolvency stats. Administrations, the larger businesses, they're still roughly now where they were pre-pandemic, so we're not seeing a big increase in those kind of numbers.
So this is essentially a good news story.
I think there's a risk that it's the calm before the storm. Of course, there's well-documented macroeconomic factors that still face a number of businesses. I think with administrations, when we see the administration process used, more and more we see that as a mechanism for value to be realised from a business that is otherwise insolvent. And I think that the reason potentially those numbers are still a bit lower than where we would expect them to be is that lack of risk appetite, the lack of buyer appetite. So if you're an investor in a business that's struggling at the minute, you're probably not going to go to market. When that confidence is restored, I think we'll probably start to see the administration stats increase as it effectively helps those transactions execute.
That's very interesting. So potentially you could see more businesses that would otherwise have entered insolvency having a fighting chance in the future.
I think you will, and I think that the actual insolvency process will often be used to facilitate that. But there is still, there is still a lot of cash investment looking for a home at the minute. So those businesses where underlying, ignoring potentially high levels of debt and stretched balance sheets that we've seen over the last few years, if there's a good trading business underneath it, then more often than not there is an option to help that business avoid an insolvency process, yeah.
Now, what are the sort of businesses that you've been handling in administration? It looks as though manufacturing is top of the list.
Yeah, I think if you look at the numbers that the Insolvency Service have released today, you see the usual suspects. Manufacturing up 20% year on year versus 2022. I think we put that down as a result of those macroeconomic pressures we talked about. The standout for me is businesses that are associated around the food sector, food manufacturing, food service. We've seen those year on year increase by 44% based on the numbers that the Insolvency Service have released. And in real terms, that's about 3,500 businesses in that sector have entered into some form of insolvency process. So that's one to watch. Construction, manufacturing, retail, they're the usual suspects. Food's the one that I'm seeing a real movement in.
And why is that? Is that because they've been hit by higher energy costs, or are there other factors at play?
I think, yeah, they've been hit by higher energy costs, inflationary pressures generally. I think what's partially unique to the food sector is particularly for businesses that are perhaps supplying the main supermarkets, it's the buying power of the end customer. So the supermarkets are trying to keep prices down. They're trying to keep good deals for the consumer. So it's much harder for those businesses to pass those input costs they're getting in production onto their customer and ultimately onto the end user. Often they're on thin margins anyway. Yeah. So actually, I think we're seeing a lot of those businesses now really struggle for cash. And
of course, the other factor is, it's a really tough time right now for hospitality. So yeah, supplies to the restaurant trade presumably are suffering.
And the restaurant trade itself. Again, I think you're absolutely right. I think that in some ways it feels like a perfect storm. Businesses generally that facing the consumer are quick to feel the pinch as consumers spend less, and I think most definitely suppliers into the pubs, the restaurants, the bars will be feeling the pain as well. Yeah.
So as we look forward to 2024, interest rates are probably going to come down. Potentially, would you expect to see the numbers continue to tail off?
In terms of number of insolvencies, I think we will certainly see the liquidations start to tail off. I think those numbers, 20,000+ companies at the minute, they're very high. And I think what you're seeing there is a lot of the so-called zombie companies that we've heard about over the last 15 years. Those companies that quite small, existing just to service very low interest costs, as the interest cost has increased, those companies were seen to fail. So I think we will see liquidations start to tail off. But I think as the buyer appetite and as the transactional market starts to come back, we could see administrations increase, but hopefully with positive outcomes at the end of those processes.
Sounds like a busy 12 months ahead for you, Matt. Good to see you this afternoon. Thank you. Now, chief executives of